All right, so today's lesson is going to start with a quick review of two key financial topics that we've discussed already, and that is investing and trading, but it's always good to review. And then we're going to get into learning a little bit more about what is the major tool or the major security that we are going to use to get started in our simulation, which is stock. And then I'll take you through the steps that you need to go ahead and uh, literally jump right in and start uh, trading, start buying and selling securities. Right. So, like I said, let's start with a quick review about investing versus trading. So, when most of us think about investing, we think of that buy and hold strategy. I put hold in quotes because we really tend to hold on to these things for long periods of time. Typically, 3 or more years is going to be would be considered investing. Uh, Many times investing or the performance of an investment or the reason we invest in a company is because we have an expectation for long-term results. We expect this company to be profitable now and in the future, or we expect the profits of the company now to help the company in the future. And the thing about investing is that the good thing and bad thing is that the stock market is open 5 days a week, so it's a good thing, but it's also a bad thing. So when you're invested, you are always invested. If you're going to take this buy and hold strategy from the minute that you click buy until the minute that you click sell, whether it's 3 years, 5 years, 10 years, or 20 years, you are always invested in the market. So as you can see by this chart, you are subject to the ups and downs of that market, and you have to be willing to ride those out. And there might be a lot of highs, there might be a lot of lows. But because you are taking this buy and hold strategy, you are always in the market or you are always invested. And so you are always going to be susceptible to the ups and downs that naturally occur uh, in the market on a daily and a monthly and an annual basis. Now, again, trading, on the other hand, uh, when we talk generally about trading, instead of talking about owning stock, we talk about taking a stock position or holding a stock position. Now, that stock position could be held for a few seconds or even up to several months or anywhere in between. And it could be done several times over and over again, whether it's with the same stock, whether it's with a different stock. Um, but really, trading has a lot to do with momentum. And so, if there is momentum surrounding a stock, whether it's good momentum or bad momentum, uh, traders will look at that as kind of their key metric, along with obviously some other higher technical analysis. Uh, but again, the big difference is that I can move in and out of the market at any point in time. I'm not always invested in the market. So if I buy shares at the beginning of the day and then I sell those shares at the end of the day, I'm not back in the market until I decide to purchase shares again. That's really one of the key fundamental differences between these topics of investing and trading. Okay? So for us, when we talk about trading, at least in the beginning, we're going to be trading stock. Now, some of us, based upon discussions and based upon results from our pretest, have a pretty solid understanding of what we mean by stock. So this might be a quick review for you, or this might be something new. But let's really think about, well, what is a stock anyway? So when companies are public, they sell shares or they sell pieces of the company. And so with those shares, you own a portion of the company's assets, which are the tangible things that have value that the company owns. So products, the building, patents, all those things. But you also have a claim on the company's future earnings. So when the company is profitable, that is reflected, or I guess the future earnings are reflected in the current stock price. And so owning a stock today is a way to say, you know what, I think this company is going to be profitable in the future, and I want to have a claim on those. I want to have, I would like some of those. Now, the thing to understand too about stock is a lot of times people will say, oh, I don't have enough money to invest in the stock market, or I only own a couple of shares. Well, whether you own just one share or whether you own a million shares, Your return on investment, which we just got done discussing, is going to be the same in terms of percentages. If the stock goes up 10%, your return on investment is also generally 10%. So we want to treat, when we're looking at stock and we're looking at making moves or holding positions, we want to look at a stock the same way, whether I owned 1,000,000 shares or whether I owned one share. You could look at that one share as kind of its own little business. Because again, if that stock goes up 10%, whether you have one stock or whether you have 1,000,000 shares, one share or 1,000,000 shares is still going to go up on 10%. Now, you certainly won't have the same amount of money, but from a percentage return, it will be the same, right? So, why do people own stock? There's really two main reasons why. One is appreciation. Now, when most of us think about owning stock, we think about, oh, I want to buy low and sell high. But again, that is purely speculation on the direction that the stock will take. We could do lots of analysis. We could look at historical trends, and a lot of things could tell us that the stock will go up in value. However, it's not a guarantee. The other reason people own stock is dividend income. And dividend income can take many different forms depending on what type of business you're investing in. But with stock, dividends are regular scheduled payments that companies make to stockholders who own shares of company. So when a company is profitable, they say to their owners, just like if you were the owner of a local ice cream shop or a coffee shop, and if you had other owners, or if you had an ownership group, everybody in that group would be entitled to a share of the profits. If you own Apple or if you own Amazon and they are profitable, that company can decide to go ahead and pay a portion of those profits to the stockholders. Okay? So let's look at a really kind of a simple example. All right. So let's suppose Red Flag Cycling makes bikes. Right. And they don't just make bikes. They make like really, really, really good bikes, like top of the line bikes. And they've been expanding and expanding and expanding. And so they no longer have the ability to just fund the business by the products that they sell. They need to expand. They need to build a new plant. They need to build a new factory. They need to hire more research and development. They need to buy more fabric to make their fancy red flags for their bikes. So in other words, the company needs capital. All right. So how does a company raise capital? Well, the first one, and we'll get into this a little bit later because this is also a different type of investment, is getting a loan. Companies can borrow capital, which means taking on significant debt. And debt is expensive because of interest. Now, for us, for the sake of trading, we're going to look at issuing stock. And by going public and issuing stock shares, a company can raise money without going into debt. It sells ownership shares and a claim on future earnings to its investors, as we discussed. Okay. So again, like I said, for the sake of this lesson and this simulation, we're really going to focus on the stock portion of companies raising capital. Okay, so red flag opts for going public, but what does this have to do with you, somebody who is looking to trade or somebody who is looking to enter the market? So what traders do is they look to the stock market for opportunities if you are willing to accept the higher risk of losing your investment for the potential of higher gains. Now, this kind of goes without saying, but I will say it. We never would want to invest, or we never would want to put money in the market that we aren't willing to lose. And the other thing is, just because we have money to invest doesn't mean we want to put all of our money into the market or take a position all at once. If I have $10,000 to invest, I may not necessarily want to put all $10,000 into the market at once. You certainly could, but you could probably see the potential risk associated with that. So let's say you decide you like the outlook for Red Flag Cycling and the momentum its stock is having lately. People are excited about it. People are riding more bikes now because of the pandemic, and it's tough to get a bike. But one of the easiest ways to make this trade is to buy shares of this stock. And this is where our stock simulation will come in. Okay. So what you're going to do from here, and you can follow along, is on Google Classroom, over in the classwork section, If you go down to general materials, you'll see there's a link here that says Investopedia Online Trading and Investing Simulation. You're going to go ahead and click on that. And then it's going to ask you to sign up, username and password. Try to use a username that's easily recognizable to you. A lot of people just default to first initial, last name, or some combination of that. Right. So once you get set up, your screen will look similar to this, and you'll see you should be entered into the Investment Strategies Challenge. Now, currently, there isn't a lot of activity going on because nobody is, quote unquote, in the challenge yet. But there is so much in this simulation that we could use, and we'll eventually get to a point where we're using a lot of these. But really, for right now, all we want to do is we just want to get into the market. Okay, we want to make a trade. We don't want to invest yet. We almost want to kind of remove the idea that I'm investing in these companies. What I'm doing is I'm trading, or I'm looking to take a position on a specific company or in a specific company. So over here on the left-hand side, I got this drop-down arrow, and I can trade. I can trade stocks. We'll eventually get to trade options. But for right now, I'm just looking at a stock. Okay? So you're probably thinking, well, I don't know much about companies. I don't know if they're profitable or not. We could really throw a lot of the fundamentals that we think about when we're investing. We could throw that out when we're trading because right now we're looking for momentum, or we're looking for movement in the markets. Okay. So, and this is somewhat timely based upon our last class and our current events presentation, is Tesla stock plunges, usually never a good thing, after being left out of the S&P 500 index. Okay, so they took a significant hit. Now, we can see here, if I click on that article, the stock dropped 21%, closing at $330. Last week, Tesla stock dropped 16%, amid a broad sell-off of technology stocks. So you might be looking at this and see, well, I don't really see a lot of momentum, right? But if we were to go back and do a quick little analysis, and I'm going to type in the symbol, and as you can see, Tesla's had a little bit of a bounce back today, right? So if I click here on this chart, and if I just look at the activity for the last, 5 days, okay, there's that plunge that we referred to when they were left out of the S&P 500. So they were, prior to that, they were trading at one point over $420 a share. And we've obviously had a significant drop off, and then we had a little bit of a spike here today. Now, let's see what's going on today. Again, there's that quick bounce. So if you remember, just a few days ago, Tesla was trading at over $420. So if you think that there is some momentum associated with this, it was just kind of a one-time thing, you could take a position on Tesla and speculate, for lack of a better term, that stock is going to bounce back to that higher level, that $420 level. Do we know exactly? No, but we could at least speculate. And the nice thing is it's not real money, and so we can use this as a way to test our theories. Okay, so if I go to my stock simulator, and I go here and I type in the stock symbol, okay, and I type in Tesla. Right now, you can see it says that the last trade was trading at $352. Now, that price may be a little bit different than what you see here, just because there is a little bit of a delay between this and the actual market activity. But if I would just want to buy, and I want to get the best price that is currently available. And when we're buying, the best price typically means the lowest price. And let's just say I'm going to start with 5 shares. If I choose to set a market order, that order will be executed the quickest, and it will be executed at whatever the current market ask is for 5 shares. So I will get somewhere around the current market price. I don't know exactly what I will get. That's the risk associated with that. So when I go ahead and I click preview order, At a price of $352, this transaction is estimated at over $1,700 plus a 99-cent commission. Right? So this says here is my information, and so this is how much it would cost me. Now, let's say instead you weren't exactly sure, or you're a little bit hesitant, or maybe you think that the price is going to go down, or maybe you think that there is still some room for some volatility in this price. What you can do is you can set what's called a buy limit order. And this is a really popular and really effective trading strategy because then we can sort of plan how much am I going to spend and how much of or how big of a position or the size of the position that I'm going to take with this. All right. So I'm going to say that currently I don't want to pay any higher than $300 and we'll say $365. That's the limit price. I don't want to pay anything more than that because obviously I want to buy it at the lowest price possible. All right, so I'm going to set a limit price of $365. Right. So at a limit price of $365, the value of this transaction is estimated at $1,825. So my transaction will not be executed until that price reaches $365. Okay? You could also go the other way and say, I want to set a limit. I don't want to buy it any lower because I think if I buy it too low, then maybe I could take advantage or I could alter my position. But I could also change that number. Okay. You could also change the duration. If you say it's good till canceled, that order will not be executed or until the limit price is met or until you cancel it. If you change that to a day order, it basically means at the end of the day if the price does not hit, then that transaction will be canceled. Right? Okay, so what I would suggest doing is, and you're going to have a lot of time to kind of research and just kind of get familiar with the simulation, is most of us are when we enter the simulation, we'll have the opportunity to, it'll look new. So if I go up here to portfolio, we obviously don't have anything in our portfolios, but you do have $50,000. Now, there are a couple of tutorials that you can check out. There's a stock basics or a stock picking tutorial. If anything that we covered in the previous 10 minutes or so is unclear, you can also look into these buying stocks. And a lot of them are pretty short. But again, most of them have to deal with investing and not necessarily trading. So keep that in mind. All right. So you guys are going to be kind of navigating and working in this simulator. And I'll obviously be here to help you guys and to answer questions. But really what we want to do is we want to get into the market. We want to know what it feels like to speculate or to think or to have almost like a hypothesis that I think this is going to happen, but then actually see what happens. And we don't have to risk any of our own money.